welcome. Thank you for taking some time out today. Over the past few months, I've gotten a lot of questions, obviously about the election, but that's a whole other webinar, which we actually kind of covered the last time back in September, where we talked a little bit about investing when it's kind of scary to invest. But more specific to today, gotten a lot of questions about mortgage refinancing with interest rates being as low as they are today. So I invited our guest to participate in a webinar on this topic, and today's guest is Rachel. You can see her there, Rachel Pierce. She's a senior mortgage advisor with Own Up, and I'll be honest right now, I was a client of Own Up, and Rachel was my mortgage person that got me started, and I had such a good experience with her that I actually said, hey, would you be interested in doing a webinar on this stuff, because I know I have a lot of clients that are interested in learning about mortgage refinancing. So Rachel's here. She's been in the business for some years now, and she's very well versed on different mortgage programs. In fact, the mortgage program that I did with her was a little bit different than just a straight up mortgage refinancing. And she'll talk a little bit about that, not specifically about me, but she'll give 3 examples of different programs that are out there to potentially use some of the equity that you have in your house for day-to-day things. Personally, Rachel is an outdoor enthusiast. She's visited 20 of the U.S. national parks, and recently hiked 500 miles. And I didn't know about that until just now. So Rachel, tell me a little bit about that. Tell me about the 500 miles. It's pretty cool.
Yeah, definitely. Not sure how familiar people are with the Camino de Santiago in France and Spain, but last year I got the opportunity to hike 500 miles from France all the way through Spain to the end of the hike, and it was amazing. You got to stay in different hostels every night. I met someone from almost every country, and I went by myself and solo hiked a 500-mile hike.
That's amazing. I think Reese Witherspoon did a movie on that, where she pretty much just hiked for a long period of time. All right, well, let's jump in. So a couple housekeeping items. There is at the bottom of everyone's screen a Q&A, I believe, button. So if you do have questions along the way, I'm going to ask Rachel to go through her presentation all the way through, but as the questions start piling up, if it's something that I think is something that Rachel should address because it's something that will help clarify the rest of the conversation, I'll pause her and ask that question. But otherwise, what I'll do is I'll just kind of let her do her thing and do her presentation, and then at the end we'll do questions. And that part of the presentation will actually be live, so you know whatever questions pop up on my screen, I can pretty much rephrase and ask Rachel to answer those questions for us. So with that said, let's get rolling here. So I'll start sharing my screen. We'll talk a little bit about the agenda for today. But one common theme that I get from clients, or one common theme that's come up recently when we're talking about refinancing, is that clients actually ask me about pretty much the American dream, which is owning one's house outright without a mortgage. And so, some of these conversations that I've had are, okay, if I refinance my mortgage and I have, say 17 years left on my 30-year mortgage, and I refinance to a 20-year mortgage or a 30-year mortgage, won't that be setting me backwards? And so I have a specific answer to that question, but I'm curious, Rachel, if you were asked that question, that am I not just getting deeper into debt if I refinance my mortgage and stretch it out to a 30-year mortgage when I have 17 years left on my mortgage?
Yeah, no, I get that question all day long. So basically, I'd say probably 6 times a day I'm asked that. But wow, there's a few different approaches to it for sure. So one is there are mortgage products. You got the 10, 15, 20, 25, and 30-year options. So a lot of people will try to stay as most in line as possible. So say you were in that 17, you could look at the 15 and 20. when looking at those options. But then also the lifelong interest. Say you're in a 17 and you go back to or 20 or 30, you, with the rates being so low right now, most likely you'll spend less on interest throughout the life of the loan and then can overpay your mortgage and save a lot of money still.
Yeah, my answer to that question is twofold. One is you can keep paying exactly what you're paying right now and potentially, pay it down quicker than that 17 years in my example. But the good news is you actually could take your mortgage payment, the minimum that you have to pay, and reduce that. And then that extra money that you have month in and month out can be used for things that you may not even have thought you could afford. So whether it's taking that vacation with the kids or whatever it is, the thing with a house is, the way that we look at it is it's kind of like a 401k. It's a savings account. Each month you're adding money to that and growing equity so that at a certain point when you quote unquote downsize, you're able to cash out the equity in that investment. And again, people don't think about their primary house as an investment, but we do. And then use it. And what happens if you pass away without ever using your equity? Well, the kids get it, or whoever your beneficiaries are. So I love the idea, and some of the things that Rachel and I have talked about with other clients in taking cash out of the house. And yes, you may be stretching the mortgage out, but at the end of the day, you're pretty much taking money away from something that is illiquid, the house, and some people call a money pit. And taking it out and actually being able to use it for some things that they may not even know that they could do. So anyway, that's a question that I get from a lot of clients, including my mother, who's in the process of refinancing as well. She said, should I actually be doing this? And I said, yeah, again, you can continue to pay what you're paying and pay it down just as aggressively. So bottom line is this is the agenda that we have for today. So what's refinancing, why and why not to refinance, eligibility, loan to debt ratios, and all that kind of stuff. And of course, credit scores and how important that is. And then we're going to talk about 3 different refinance scenarios, the process, and then we'll talk a little bit about, and I'll give a plug to Rachel and her company, because they actually did do a great job. So I was actually very pleased with them. And my big disclaimer, of course, and this is for our compliance department, is that my experience was one experience, and hopefully you'll have the same experience, but I can't guarantee that if you use OwnUp that you'll have the same positive experience that I did. So with that said, I'm going to turn the microphone back over to Rachel and let her take it from here.
Yeah, definitely. Thanks everyone for coming, and we'll jump right into what is refinancing and through the agenda that Brendan just went over. But basically, refinancing is the process of taking out a new mortgage to pay off your current mortgage. And there's a ton of different reasons why you would do this and when it makes sense. Right now, with the interest rates at historic lows, definitely taking advantage of lower rates in a straight rate and term refinance. If you're currently in like an ARM product or an FHA product, it's a perfect time to get into a fixed rate mortgage or a conventional mortgage. And then changing your term, like Brendan was talking about, you can make your mortgage longer, make it shorter, change the duration to have more flexibility with payments or to pay your mortgage down more aggressively. And then cash out, tons of different reasons for taking cash out. Today, I've had so many people reaching out about doing home renovations right now. Seems like everyone's doing them. That's a huge reason to take cash out. And then another reason is if you have any debts with higher interest rates. And I always tell you to look back to your financial advisor on that, because you don't want to take equity out of your house, pay off a ton of debt, and then run the credit cards back up. And then the other reason is removing your private mortgage insurance. If you're currently in an FHA product and you have more than 20% equity in your house, perfect time to get rid of that.
Got it. Okay. Next slide.
And then, Perfect. So there's a lot of circumstances where refinancing makes sense, a lot of circumstances where it doesn't. So we'll start with the most common reasons why you would refinance. And the first one, as everyone's heard, interest rates are really low, and taking advantage of the current interest rates to reduce your monthly payment, probably top reason we have people calling in all day long. And then, like I said, if you're in an ARM product and you plan on staying in the property, it is definitely a good time to get into a fixed product. And then just changing that loan term. A lot of people are looking at getting into the 15 years with the rates being even lower on the 15-year mortgages. And then the opposite, where people want more flexibility in their monthly debt ratio, and they're looking at extending it to the 30 years and still cutting interest off the life of the loan. And then if you have more than 20% equity in your house, that's where you can start looking at the cash out refinance. You have to remain with 20% equity in the house to do a cash out refinance. And then the same thing that I said about getting rid of the private mortgage insurance if you're in an FHA product, or even if you are in a conventional loan product and your equity in your neighborhood has gone up a lot and you don't currently have 20% equity without a formal appraisal, this could be the time to look into that as well.
And just a couple points of clarification there, because you and I, Rachel, work with this each and every day. What is equity? And I think just a very quick example is equity would be if you have a $500,000 house and you have $400,000 mortgage, you have $100,000 of equity, and you pretty much take that $100,000 divided into the $500,000 house, which means you have about 20% equity, which is a nice way of saying the bank owns 80% of your of your house. That you own 20%, they own 80%. And then the other thing that I just wanted to ask Rachel is, do you have a rule of thumb? So when people come to you and they say, my mortgage is at 3.5, at what point would you actually say that it makes sense for them to actually refinance? At what rate would you say is a good time to actually start thinking about it?
Yeah, so I would say anything above 3.5% is definitely worth looking into. If you're above 3.75, if you plan on staying in your house, it's almost always going to make sense to refinance. The few situations where it wouldn't is if your credit is low right now. The rates may not be favorable, but it's still worth inquiring, getting the information, and seeing if it is or isn't worth it. But above 4%, it's going to be a no-brainer to refinance, assuming credit is good. But even if you have like 5 or 10% equity in your house, it'll still end up making sense. Like a lot of my friends have bought houses in the last year and are already last 1 to 3 years and are already refinancing because rates were above 4 when they were buying, and now they're getting into the high 2%, which is
okay. So is a good rule of thumb about 0.5%? If your mortgage rate is at 3.5 and the going mortgage rate at the time is about 3, that difference of 0.5, is that kind of a good rule of thumb?
Yeah, and especially if you plan on staying in your house for at least like the next 5 years.
Okay, which is a good segue to why not to refinance.
Yeah, so why not refinancing? So the first one, definitely the rates are low, but you would need the refinance to offset the closing costs in a reasonable period of time. So like my sister's mother-in-law the other day reached out, and she's been in her house for like 20 years, only owes $50K left on the loan. And in that sense, she would end up paying more interest over the life of the loan. So there are situations where it absolutely won't make sense. Usually when you've been in your loan and mortgage for a long time, unless you're looking to offset those payments. But then also if you plan on selling your house in the next few years, you won't get to enjoy those payment savings of the interest. You'll almost just break even after like 3 or 4 years typically. And then if your credit scores drop since you bought the house, it may not make you eligible for meaningful savings. Still worth looking into. Honestly, if your credit score is above 680, it's worth inquiring. I think below 680 and your rates are below 4% right now, you're probably not going to see meaningful savings, but you can still always inquire about it. And then the biggest one where it almost never makes sense is if you bought your house as a primary and now it's an investment property. Those rates are always higher. The lowest I've seen investment rates go are like 3.625 this year. So if your rates, if you bought it as a primary, you're most likely not going to have it make sense if you've turned it into an investment.
Okay. Let's talk a little bit about the refinance eligibility and some of the important factors that you take into consideration, or the mortgage underwriters will take into consideration.
Yeah, so there's really three things, and I try to make it as simple as possible. So first being your credit score, and there's different credit thresholds. So essentially, if you're above 740, that's where you're going to see best rates in terms. And then if you're like kind of between 720, 740, 700, 720, there's different thresholds. But anything above 700, you're still seeing awesome rates right now. And the next thing you're going into is the debt to income ratio. And that we're going to dive into a little bit on the next slide. And then sufficient equity, like Brendan was saying, the amount of equity you own in your house versus the equity the bank owns in your house. And then the cash out refinances have a few different requirements, and the rates are always slightly higher than a rate and term refinance. So when deciding if you're going to do a rate and term refinance versus a cash out refinance, you always want to inquire about both if you're not sure if the cash out or rate and term makes more sense, because your cash out will hold higher rates than the rate and term.
And again, we'll get into all of what that all means, what a cash out refinance is versus a rate and term refinance. So don't get too hung up on the jargon here. So credit score, one thing that's really big with our company and kind of why we do it is starting with like a hard credit pull versus a soft credit pull. The hard credit pull is when all three of your credit bureaus are pulled. So your Experian, Equifax, and TransUnion are all pulled. And that's when you get a ding to your credit. And we never, ever do hard credit pulls unless you're actually applying for a refinance or buying a house. We only do a soft pull. So we pull your TransUnion and Experian, and it doesn't give you a hard credit pull. And we get all the information we need to pull quotes for you and to figure out your debt to income ratio. And the lower your credit score, the higher the interest rate you see. The higher the credit score, the lower interest rate you see. And it's really just taking that credit score to put you in a threshold when shopping rates for your mortgage and figuring out what rates you can get. Okay.
And then debt to income ratio, I'd say this is the most complicated part about mortgages for people, and kind of really breaking down this ratio as simple as possible is taking all of your monthly debt obligations. So that would be like a car payment, a student loan, your mortgage, your taxes, insurance. It's taking all of those monthly minimum payments and then dividing that by your gross income. And that ratio needs to be below 43%. And then when we're qualifying income, really easy when you're salary W-2'd, even commission, bonus, rental income, and then self-employed, we just look over tax return and see what we're able to qualify based off of write-offs and whatnot. But we just take all of your debts, divide it by your gross income, and this is just a qualifying ratio.
Right, let's get into a couple scenarios and some real rates and different programs that you have, Rachel.
Yeah, so scenario one, definitely the most common. A rate and term refinance is just when you're not taking any cash out, not consolidating any debt, and you're just taking your current mortgage and refinancing it for a new mortgage. So this example is a $300,000 mortgage. The loan term is 30 years. And the rate is currently at 3.75%. And if you look at what the current monthly payment is, you're looking at $1,389. And then over the life of the loan, over 30 years, you would essentially in this loan be paying $198,606 in interest. So if you look at refinancing where the market is right now, you have the same loan, same years, but now your rate goes down to 2.875. So you're looking at saving $144 monthly, and then over the life of the loan, $51K. So this is the most typical refinance that people are doing. And this would be if you're just looking to change your current mortgage into a lower rate to take advantage of how the interest rates have dropped and monthly savings and lifetime savings on the loan.
Got it. Pretty straightforward.
Right. The second one, a little more complex, but essentially I'm taking the same example. And this is if you want to take cash out, and this could be for renovations for your house, for paying off different debt lines, just wanting to have access to the cash. Some people honestly have been taking it out for all different types of reasons. But in this situation, you have the same loan size, 30-year, 3.75, same exact situation on the left. But on the right, now you're taking $50K cash out and your rate's 3.125. And like I said, with the cash out refinance, rates are slightly higher than the rate and term refinance. And in this situation, your monthly payment goes up $109, but you're actually still saving $10K over the life of the loan. And that's because the interest rate on that 350 is 3.125 compared to that 3.75. So essentially you're getting access to $50K extra, still saving $10K over the life of the loan, and your monthly payment's only going up $109.
So just make sure that everyone understands what a cash out refinance is. On the left side of the screen, you're pretty much taking that 50,000, or you're pretty much, that's your current loan at 300,000. What you're doing on the right side, which would be the refinance, is pretty much refinancing that 300, but taking a check out at closing for $50,000. And so, one situation where this might really help someone is if they have credit card debt, where they, have accumulated $50,000 of credit card debt for whatever reason, whether it's a new baby, job change, coronavirus situation, whatever. Taking a credit card that might be charging you 15 to 20% and taking a check out of it and ultimately paying 3.125 on that $50,000 is huge. And not to mention the emotional stress that you have carrying a $50,000 credit card balance, shifting it to the mortgage makes a ton of sense, even though you are paying $109 more per month to do it. You can breathe a sigh of relief that that credit card is not as high as it is. All right, so scenario 3.
Yeah, scenario 3, consolidating refinance. So this would be very specific. You would have to have a second mortgage or a second lien that could honestly be like solar panels, Mass Save program for anyone in Massachusetts, or a home equity line of credit. And you would be taking first mortgage on the left, same example, so that 300K, 3.75. And then for this example, we used a home equity line of credit that someone had opened for 25K. And this rate is already up at 4.25%. And you're paying a monthly payment right now on the interest for $88. So when you consolidate all of this, it's considered a cash out refinance. So you're taking cash out to pay off that second lien. And that really could be a home equity line of credit, second mortgage, or solar panels. And you consolidate this all. So the new loan now is $325K. So similar to the cash out refinance, but very specific on what you're paying. And then your rate's at 3.125, and you're saving $85 a month, and over the life of the loan, $40K. So anyone that has a second lien, usually almost always makes sense to consolidate those.
Yeah, and that's a really good example, and that's I'll let a little personal information. That's pretty much what I did with Rachel. Is I took my home equity line of credit, which is known as the HELOC, HELOC, and it was right around there, right around 4.25, and I rolled it into the mortgage and got rid of the home equity line of credit and reduced the monthly payment. So it's remarkable that if you look at that $25,000 over a 15-year period at 4.25. When you wipe that out and roll that into the mortgage, you actually can save some money. So there's lots of different structures that Rachel can help you out with to try to figure out what's the best option for you.
Yeah, so refinance process right now, prior to COVID and prior to rates dropping, it was like a 30 to 45 day process, definitely 60 days. So from the day you make a decision, you're like, I want to start this, I'm going to do an application, you're looking at 60 days until you're in your new refinance. And you always end up skipping 1 month of your mortgage payment during the refinance process. And you generally do need an appraisal. There has been waivers right now, cash out refinance or doing a consolidating refinance. You always need an appraisal. But with COVID, there has been new restrictions and new guidelines made. So if you're doing a rate and term refinance, you may qualify for an appraisal waiver. And then just documentation required. You end up getting a new hard credit report when you apply. You do get W-2s, and then you get pay stubs and current mortgage details that you have to send in.
Rachel, I just got a question. I'll just throw this out. One of the folks has to drop off early, but they were asking what states are you actually able to, and I might be more specific, own up. Does Own Up operate out of all states, or is it just Massachusetts now?
So Own Up, we are licensed in, we have lenders in all 50 states, so we can help anyone in all 50 states. But like personally, we can help people in all of New England, and then Pennsylvania, Texas, and Georgia, Florida. And I can send a list after, but it's quite a few states that we're able to help in, Pennsylvania. And then if we're not licensed in that state, we'll get you to a lender and they'll still honor Own Up's pricing and everything like that.
Got it. Okay.
And then typical refinance cost for the actual closing cost. These are just all the typical things that you're definitely going to have in a refinance. And they all do vary lender from lender. So these are things that we're helping shop out. So once I run through Own Up, we'll kind of explain how we shop your rates out. But appraisals will vary kind of between that $350, $600. You end up having an attorney or notary for closing, depending on which state you're in. And you'll end up doing like the title insurance again. So these are all things that we're getting pre-negotiated and getting the rates as low as possible throughout the process.
Got it. And then just to put an exclamation mark on this, these are the fees that when you're making that refinancing decision, you have to figure out how long will it take when I refinance my mortgage and have lower fees. How many months, how many years will it take with that lower monthly payment to offset the fees that I'm going to be paying to refinance my mortgage? So that's really the calculus you have to kind of think about when you're actually trying to figure out, does it make sense or not make sense to refinance?
And then perfect segment into this. So this is on the left, a full cost refinance. That's taken into consideration all the stuff on the page before in regards to the closing cost. So you see like the appraisal fee, origination fee, all of that adding up to $3,000 on the left for a full cost. On the right, so there's a few options on how you can go about refinancing. So on the right's a no cost refinance option. So you're taking a slightly higher interest rate. So if you see on the left, the best interest rate for you would be 2.875. But if you take 3.25, the lender gives you a credit offsetting all the closing costs. So you get a 3.25 rate for paying absolutely nothing. And you're still getting to take advantage of savings. So that's like one option. The other option is paying the closing costs like on the left. And on the left, that's usually if you plan on being in the house longer term, have access to that cash, definitely what I would recommend. On the right, if you don't have cash that you want to invest in a refinance right now, that's a no-brainer in regards to savings if your rate's higher than that by even 0.5% point or more than that. And then you also have the option of rolling the closing costs into the loan as well.
Got it. And I just ran a quick calculation here. The difference between those two rates on a $300,000 mortgage is about $1,100. So what that pretty much means is if you're going to be in the house for 3 years or less, then it's better to do the no-cost refinance. However, if you're going to be in there for 10 years plus, that higher interest rate on the right, the extra cost is going to more than, it's going to be more expensive to do the no cost. So in that specific case, the break even is about 3 years, that it would be better to actually go with the full cost refinance than the no cost refinance.
And then this is just a graph of mortgage rates from 1990 until now. So you can see mortgage rates 1990 up at 10%. and now they're at historic lows. So anyone that got a mortgage, and you can kind of see where you fall in on the graph on when you purchased your house or last refinanced, and this graph will be a pretty good indicator if you should look at refinancing right now.
And then Rachel, I'll ask you, I'm looking at the far right, it looks like there's been an uptick. What's that? Is that around what time frame was there, that uptick?
So that happened like right kind of when the pandemic started. Rates dropped really low, January, February, March. Then March, there was like a few week uptick period, and then everything dropped back down. And rates have been slightly coming back up since that refinance tax got announced. That goes into effect December 1st, but that doesn't affect clients on a direct level. That's a tax that lenders are going to have to pay.
Got it. And in terms of, one of the things that I get from a lot of clients is, where can I find what the going mortgage rates are without having to call Rachel every day to say, did the rates go up or rates go down?
Yeah, so I use the Daily Mortgage. It's a third-party resource, and I check the rates there. It shows you the U.S. industry averages. So it's a good indication as to where the rates are. But basically, like with our platform, you'll now get an email every day with your personalized situation where the rates are at. So you'll be able to look at where they were yesterday, where they are today, and just kind of monitor the market for what you're looking for.
Okay. All right, so this is where we get into a little plug for Own Up. Again, just my personal experience, the thing that I really liked about Rachel was that she was accessible at all hours. It was right around 4th of July weekend, and I was up at the Ben & Jerry's ice cream factory, and I filled out a mortgage application online on my phone. So I thought that was pretty cool. And I was texting Rachel and saying, should we lock in now? Should we do this? Should we do that? So I was actually very impressed with them, but she can give you a little infomercial about Own Up.
Yeah, definitely. So Patrick and Mike, co-founders, Patrick CEO and Mike COO. So they actually really got the idea of Own Up when they were shopping for their own mortgages, buying a house, specifically Patrick. And he was the senior vice president at a top 10 national lender in the US. And he was doing $11 billion a year in residential mortgages and didn't even use his own bank when he went to get his mortgage. So that was a huge moment when he wanted everyone to be able to get a mortgage the way he did. And big thing with them was really finding a way that all Americans can essentially get a fair deal on a mortgage and not end up having 10 people go into the same bank with the same exact scenario and walk in with 10 different interest rates and closing costs. So it really is like an online marketplace of lenders where we're able to shop your rates out and anonymize all of your information, which is huge. And really kind of diving more into that specifically is if you were to go into your typical bank, broker, anywhere that basically when you bought your house or when you've previously refinanced, that person that you work with makes a 1% to 2% commission on the loan amount. And they kind of negotiate the rates and figure out where they're going to place your rate based off of essentially like your personality when you walk in. And with us, we take all of your information, anonymize your data, and all the rates with our lender platform are pre-negotiated. And this is a big part. They're all pre-negotiated at 0.4% compared to the market average of 1% to 2%. And then we can bring those savings back to you in regards to like interest rates and the closing costs of the loan. And we're shopping your rates out across 45 different trusted lenders and then bringing the best rates back to you. And every lender has a different portfolio of who they want to buy like the mortgage from. So there's usually a really good match. And if there's something that doesn't make sense and we don't think we have the best rates for you, we're going to be the first people to tell you that we don't have the right lender and try to point you in the right direction. And then just reviews, definitely encourage you to check out the reviews of Own Up. And I picked these three out. They're just three very different examples. But like DJ on the left was happy he was able to find the lowest interest rate. We have a lot of people that come to us that have been shopping rates out on their own. And that's always my favorite because they'll send me the loan estimates and they'll be significantly higher in interest rates and closing costs. And I can compare them and explain how much the rates are better. Then Matt, just quick, painless, and effective. So it was simple for him. Then on the right was someone I worked with for over 3 months who was really busy. She's actually like an investment banker and predicted that rates would drop and wanted to monitor the market. So the second the rates dropped, I was able to notify her, and she had predicted kind of when things would drop. Really, really interesting to work with also. And I was able to send her a text, let her know rates are where she wanted them, and she was able to do the application that day, which was awesome.
Got it. All right. Well, guys, this is where we get into the question and answer section. I only had that one question throughout the workshop, so obviously Rachel and I did a fantastic job of explaining everything crystal clearly. But is there any? And again, I see one question just popped up. So let me read that and make sure that it's not an inappropriate question. Just kidding. Okay, so the question is, where do we see rates going in 2021? Do you think that it's going to, is this like, the golden time to jump on these low interest rates, or is there an opportunity in 2021 to refinance if you're not ready to refinance right now?
Yeah, I'd say definitely don't have a crystal ball in regards to rates. People ask that a lot. I think if it makes enough economic sense to refinance now, I wouldn't risk waiting to see where they'll go. Just where they are at the historic lows, I'd personally get on the rates if it makes sense for your situation and at least inquire about it. And it's so hard to tell. I think it all will depend a lot on where the election goes too.
Interesting. Yeah, I have a little different perspective on it. I actually do think that rates will stay pretty low for a good chunk of time, just simply because, it comes down to the national debt. Our national debt is, I'm going to keep my editorial comments to myself, but needless to say, it's very big. And in order for the United States to continue to not go the way of Argentina or Greece, they have to keep interest rates low, which means that money that you get at the bank is not going to make all that much money, which is a bad thing if you're the lender to someone. But on the flip side, if you're a borrower, it should be a good thing. Now, of course, again, compliance department, I'm not predicting anything, but just generally speaking, from a lot of the folks that I listen to, the expectation is that rates will remain low at least through 2021, and we'll see what happens from there. Good question. Okay, anything else? I don't see any questions right now. I'll wait another 30 seconds and see if there's anyone else that wants to pose a question. And if not, then we'll just we'll call this a wrap. So, Rachel, thank you, and thank you everyone that participated in the webinar. Hopefully, you got some good information. If you have any questions or you need Rachel's contact information, I'm happy to give it to you. As I mentioned, I had a great experience with her, and that's about it. So again, Rachel, thank you for participating, and I think we'll call this a wrap.
Perfect. Thank you.
All right. Take care, everyone.